Good afternoon, everyone. My name is Sandy Isley. I'm a tax principal in MBAF New York City office. In our last webinar, we worked through the loan forgiveness application in detail. Since then, there have been a number of important developments, including a couple of new loan forgiveness applications. The Paycheck Protection Flexibility Act was signed into law, providing for a new covered period option of 24 weeks. We can now have up to 40% of the forgivable loan amount be spent on non-payroll costs. There are new rules on employee owner compensation, special situations, such as subletting office space and related party rent payments. We are honored to have a very special guest panelist joining us today. Janelle Hine is the Deputy District Manager for the SBA South Florida District Office, and she has 29 years of experience with the administration. We also have David Evangelista, who is a principal in our Valhalla, New York office, David Mushavelli, who is an audit principal in our New York City office, and Maggie Reach, a senior manager in our Miami office. Tammy Comenza, who is a principal from our Fort Lauderdale office, will be monitoring your questions throughout the program. We are all members of MBAF PPP Loan Advisory Team, and along with the rest of the team, we have spent the last 7 months immersed in researching and analyzing all aspects related to the PPP loan program. 3 quick administrative points. You should have received a copy of the slides you'll be using within the past hour. If you haven't, you can send an email to marketing@mbafcpa.com. Tomorrow, you will receive the slides and a recording of the webinar emailed to you. Please submit questions in the Q&A section of the control panel. If we do not address them during the webinar, we will reach out to you after the webinar. Today's webinar runs for 90 minutes with a short Q&A session at the end of the webinar. The webinar qualifies for up to 1.5 CPE credits. If this applies to you, please participate in the 3 polling questions that will be asked during the webinar. We will distribute the CPE certificates tomorrow. Let's go ahead and get to our first polling question. Has your bank opened a platform for you to submit documents, and are they accepting forgiveness applications? While we wait for the results, Jonelle, can you possibly comment on where SBA is at in terms of processing applications with the banks? Janelle?
Sorry, I forgot to unmute myself. Thank you for the question. We opened up the SBA portal that the lenders use to submit the forgiveness applications as of August the 10th. And by the beginning of October, we had already received about 96,000 applications. And I know that just last week, we started remitting the payments for that forgiveness amount to our lenders. Just wanted to highlight, though, that the applications that our borrowers are filling out have to go to their lenders. They don't go directly to the SBA. And then the lender will submit that application on to the SBA after they do their review. And some lenders I know are still not accepting applications. So the borrowers just have to stay in close contact with their lenders to find out when their portals will open.
Thanks, Janelle. And to support what you just said, we have 42% who say no, nothing is ready at this time. 34%, yes, portal and applications are ready to go. 24% portal is available, but no application can be submitted yet. Now let me turn it over to Maggie, who will start us off.
Thank you, Sandy, and thank you, Janelle. It's nice to speak with you again on a webinar. So a lot of the questions we've been getting recently have been, when do I apply for loan forgiveness? And when is my covered period? Is it 8 weeks? Is it 24? Or is it something in between? So to analyze that, let's go back a little bit to what Sandy referred to as the PPP Flexibility Act that was signed into law on June 5th, and it amended the CARES Act. And what it did was it provided for a a longer covered period, a 24-week covered period. So if you received your PPP loan before June 5th, your 8-week period is a default, and you have an option to elect a 24-week. Your loan maturity is also defaulted 2 years, or you can elect 5 years, and you can negotiate that and discuss that with your lender. They should be able to change the maturity on that to 5 years, no problem. If you received a loan on or after June 5th, your covered period is a default 24 weeks or shorter based on when you submit the loan application. So I just want to clarify that the covered period is 8 or 24 weeks, or when you submit the loan application if it's before 24 weeks. You can't just say, I want a 16-week covered period. What you can do is you could submit 16 weeks of payroll costs, but your covered period is still going to be 24 weeks unless you apply early, and that cuts off the covered period, the application date. So let's say you do apply early, you submit the application, before your 24 weeks, that FTE count is going to stop at that end on the date you submit your loan application. However, if you have a salary hourly wage reduction, that's going to be projected out to the end of the 24 weeks. So if you're really looking at this at a high level, your thought should be, if I have one of these reductions and they might impact my forgiveness severely, meaning I won't get 100%, we recommend going out to 24 weeks and maximizing how much in payroll costs that you submit so that the quotient really doesn't hurt the forgiveness amount. As well as if you receive the loan on or after June 5th, your loan maturity is a default 5 years. We also get questions on when can I submit my application. You can actually submit your application up until the maturity date. So you can submit it at year 4 or year 5. However, we recommend submitting it within 10 months after the end of your covered period, because that's the deferral period for any loan payments such as interest or principal or fees. So we recommend the 10 months after the end of the covered period to submit the loan forgiveness application so that you don't have to make any payments on the loan. And also new is the alternative covered period, but this is only available for frequent payroll cycles such as weekly or biweekly. If you have a company with multiple payroll cycles, some cycles in that company are weekly or biweekly, but others are semi-monthly, you cannot choose the alternative covered period. You must start on the day you received your loan funding, and that is the start of your covered period. Also to consider is timing, right? So let's say you submit your loan application today. We're at October 21st, 2020. Your lender has 60 days to submit a forgiveness decision to the SBA, and the SBA has 90 days to turn around and remit the forgiveness funds to the lender. So the max amount of days you have is 60 plus 90. If we submit the application, like I said, today, the lender has until December 20th to review, and then the SBA has until March 20th to remit the funds, and that's when forgiveness is given. So as you can see, we could be falling into 2021, even though, Jonelle, right, you mentioned that the SBA has already started to forgive some loans.
Correct.
Right?
Yeah, I don't know the specific number, but I have been told that we have, yes, started remitting the forgiveness amounts to the lenders on some of those loans that have already been submitted.
Right. So to consider in that fold right there is what's going to happen after the election. We have two different administrations with two different tax plans. We have Biden coming in with an increase to the corporate tax rate to 28% and an increase to the individual tax rate to 39.6%, while Trump would like to maintain 21%. I heard he wants to go down to 20, but for now, maintain 21% and the individual rate at 37%. So this is an important consideration if you're going to be getting forgiveness in 2020 or 2021, because we know that right now the expenses attributable to the forgiveness amount are not deductible. So to showcase kind of how this would work, we have our TI modeler. So basically under this, we have a few assumptions here based on the PPP loan amount and the forgiveness amount, and two scenarios. One is forgiveness in 2020, while the other is in 2021. So let's say we have forgiveness in 2020 without the deductibility of those expenses, which we're still waiting on Congress to pass their bills that provide for the deductibility of those expenses. But let's say nothing happens because we are in a bit of a standstill. So that is a taxable event. If you have forgiveness in 2020, essentially you're going to be taxed on the amount forgiven because you're not getting the benefit of that expense deductibility. So if forgiveness is in 2020, we're going to pick up that income in 2020. If forgiveness is in 2021, then in tax year 2020, you have nothing. You can deduct those expenses that you had for the PPP loan amount. And then in 2021, we show no income here because it already happened in 2020, but then we pick it up in 2021 if the forgiveness is in 2021. So under the Trump plan, your tax is the same. All it is an acceleration of income in one year and not the other. So it's simply a timing difference. But if we drop down and we go to the Biden tax plan, we could see that in 2021, assuming this is a corporate taxpayer or borrower, we go up to the 28%. Essentially, you're paying more tax under the Biden plan if you're given forgiveness in 2021. So, this is the worst case scenario. We're really projecting Congress to come through with an allowance of the deductibility of those expenses, those payroll costs, and rent and utilities. So, that's the worst case scenario. We're just modeling it out for some of our more risk-averse taxpayers. So I'm going to turn it over to David E. to show us the 3 SBA loan forgiveness applications.
Thank you, Maggie. Good afternoon, everybody. So for those of you who are not aware, there were originally, at the end of June, the applications for forgiveness were expanded to 2, and then on October 8th, a little earlier this month, it was expanded to 3. So I'm going to start with the newest one, the Form 3508S. It was issued, as I said, October 8th. It comes along. It also had instructions that were issued. So if you're interested in this form, make sure you get the instructions. One thing I want to point out on all 3 of these applications is you see in the upper right corner underneath that OMB control number, you see this expiration date. That caused a little concern earlier this month as people flipped the calendar over from September to October and looked at these forms and said, my God, I need to get my application in by October 31 for forgiveness. That is not correct. SBA did clarify that. They put out some guidance at FAQs. What happened was that is a date that's internal. It's part of the Paperwork Reduction Act. You see that on all federal forms. It's just when it's an expected date that this particular form will expire. It's a temporary expiration date. But the date will be extended and all these forms will be reissued. Correct, Janelle? They'll be reissued with new expiration dates at some point.
You are correct, yeah.
Yeah, so just be aware of that. I'm not sure it's really going to make a difference. If you're not applying now, you're going to wait and just download the current form later on when you apply. The other concept I want to get, because I've seen a lot of articles published lately after this form came out, this form is not automatic forgiveness. There's still a concept of automatic forgiveness. It's being bounced around the Hill in Washington. They're talking about $150,000 or less in loans, maybe some sort of graduated amount that would be automatically forgiven. This is not automatic forgiveness. You need to do some things to get your loan forgiveness, even utilizing this simple form, this S form. Other things to note, it's for loans of $50,000 or less. But if you did have affiliates, whether the affiliates are under one loan or they're just affiliated to your entity, if in total your loans aggregate $2 million or more, you cannot use this form. So what is this form doing for you? It's letting you certify to a few things, including that the costs were eligible, the costs meet the 60% were used for payroll, that you didn't exceed the 2019 compensation for owner employees. We'll talk about that later. And so you're making these certifications, but you also do have to submit documentation. The documentation proving that you paid payroll, that you paid the rent and utilities and interest. Those documentations are still going to be submitted with this form to your lender and subject to possible review. So one question, Janelle and I talked about this a little bit, because I'm going to go next to the EASY application, which specifically talks about self-employed. You know, with self-employed person looking at this form and they have to submit documentation, way back in the beginning, you know, it was confirmed that there was no requirement that people receiving loans open a separate bank account from which the loan proceeds would be dispersed. And the self-employed individuals was later clarified that this was replacement, income replacement. So, Janelle, if they use this form, it sounds like they're still going to be required or expected to submit some sort of documentation for the use of the funds. So what's your interpretation of that?
That is my interpretation, but I've taken that question and sent it up to our headquarters level to get more clarification so I can provide to you, and then you guys can send it out to the people that are attending this. But yeah, my initial interpretation is that you would have to have some sort of documentation showing what you use the money on.
Thank you very much. And certainly I think a lot of your participating lenders are going to be anxious for that information as well.
I agree.
So the next application in the series, if we flip a couple pages forward here, is going to be the 3508EZ, and that came out, like I said, at the end of June. Now, again, there's going to be certain documentation with this form and the 3508. There's going to be two types of documentation: documentation that goes along with the form, and documentation that the instructions say you must maintain and keep. So just be aware of that there is documentation, and you need to make sure you have it all. You don't have to submit it all, but if you don't submit everything, you make sure you keep the other stuff that's under the items you must keep. And that's on page 4 of the EASY instructions. You'll see the list of documents not needed to be submitted, but you need to retain. So who can use the EASY form? Well, you have to be able to check one of these 3 boxes. First box, pretty simple. You know, versus that 3508S we just looked at. This one you can see in the first box talks about self-employed individuals. So this form is a little more geared towards, again, we don't have that answer Janelle promised or is going to try to help us get, but again, this is more geared for self-employed. What's in the second box? The second box you can check off if you have both. See the and in the middle, you have to have both. The first part of it is you have no salary and wage reductions. There are no employees during the covered period where you reduced the 25% reduction in salary and wages. And you had, in this case, for the second one, no FTE reductions. Now, I just want to point out that it's no FTE reductions or ignoring the reductions that are inside the parens here, which are the inability to rehire, et cetera. Just note that for being eligible to use this form in those ignore reductions of FTEs, you do not see the for cause provision that you're going to see later on that can be used as an exception for not having an FTE, but it doesn't make you eligible under this particular bullet to check that box. And then down the bottom, we have the last set of 2 requirements. Same first one, that's that same no salary and wage reductions, but the second one is a little bit unique. And I'm going to go through it and I'm going to ask Janelle's opinion. So it talks about not being able to operate during the cover period at the same level of business as before February 15th. Now, I do want to point out that this language here on the full form 3508 is actually FTE safe harbor number 1. So you see it here on the EZ. You also can use it on the full form 3508. It's there. But definitely you're going to need documentation. You're going to have documentation in your records to keep that you prove that you met this requirement. But the conversation that's come up is this a cliff? If I was unable to operate, I couldn't have, my revenues were lower than they had averaged before February 15th, my employees were lower, and for the last 4 or 5 months, almost 6 months, I've operated like that, and then I'm able to reopen back to where I was before. Is this a cliff? If on the last day of my covered period, I have all my employees and my average revenue pop back up, am I now excluded from checking this box just because I had 1 day in my covered period, Janelle?
No, to my understanding, it's you take the covered period in totality. 1 day or 1 week or 1 month where you've seen an increase in your business activity level which I have to say also still has not been defined for us. Like you said, it could be a loss of employees, it could be a loss of revenues. I don't know exactly what the reduction in your business activity means yet. But to me, it's the totality of the covered period. It's not if you have, one sweet spot and then, before that you had maybe some rockier waters that you were going through.
Thank you very much for that. And as we go through the presentation today, I want everyone to note, we're going to have a lot of areas where we're going to point out that there's still more guidance to come. There's still nuances, there's still interpretations that are yet to come. So we're going to run into a lot of areas like that. The next page we have here is the actual front of the loan application. This is actually the calculation portion of the 3508EZ. You can see the top 4 lines. That's where you put your costs incurred during your chosen covered period. And then you go right to figuring out how much I can get forgiven. You add up your costs, put in your loan amount. You have to have spent at least 60% of what you're asking to be forgiven on the payroll costs. And then you can get forgiven up to your loan amount. I do want to point out that you can put your total cost for your period, especially because we've gone from that 8-week period to the 24-week period. You certainly can put all your total costs on line 1 through 4. You can submit documentation to your lender of your total costs during that entire period. The SBA recently put out guidance to lenders that they can accept documentation that proves costs are higher than the amount of the loan. And they don't have to review all of that in detail once they get to the point that they substantiated enough to substantiate your loan. So we do expect people, especially when we get to the next form, to have more on those lines 1 through 4 than the total amount of their loan. So with that, if you're not eligible at this point, for the few of you who might be left here now, can't use the 3508S, can't use the 3508EZ, you're going to be directed into the long form 3508. So you can see here right away, it's a fairly longer application. There's some additional questions you have to answer down the bottom of the page there. You have to say exactly what your payroll period was. You have to specify your covered period, or if you had the alternate covered period, exactly what those dates are. And more importantly, way down the bottom, you see this little checkbox. Again, if you had loans together with this one application or aggregated with affiliates, to your business. If in aggregate you have excess of $2 million, you check the box. And Janelle, that means you're giving them a call?
That's quite possible, yes. We put out some guidance earlier on in the program. Our administrator stated that we would be doing a deeper dive on loans where the amount was $2 million or more. That doesn't mean that we took away our right to audit any loans under that amount, but for the predominantly, we're going to be focusing on those. So I think, yes, if loans in aggregate of $2 million would fall into that same basket.
Thank you. So I'm going to say it several times, and our other presenters will say it too, documentation. Keep your documentation. Make sure you submit the required documentation, because any loan can be looked at later. So the next slide that just came up, you see the front, the numerical portion of the 3508. You see those same 4 lines 1 through 4 to put those costs. We'll talk more about those in a little bit. But here you see these other lines 5, 6, and 7. So remember, to use the EZ and essentially to use the S, we could not have had salary and wage reductions. We could not have had FTE reductions, or we can't have situations where we need to prove that we have exceptions from the FTE reductions, the safe harbors. So if you have any of those, you're going to have to fill this out and use lines 5, 6, and 7. Now, remember what I just said about putting in all your costs during your elected covered period, not just limited to the amount of your loan. Why? Well, because you may want to have extra costs if they're allowable and if they were during your covered period on lines 1 through 4. In case you have reductions on lines 5 through 7, you can essentially absorb those reductions by those extra costs you paid by the extended covered period. And at the end, you may get down to even having FTE reductions or having, say, salary and wage reductions, you still may get down to an amount that represents 60% of your payroll costs and still exceeds or equals your loan amount and still get your whole loan forgiven, even though you had some reductions. So that's kind of an important thing to visualize as you're looking at this form. And we've seen examples with real client data at this point where people are able to absorb some of those reductions and still get 100% or nearly 100% forgiveness. and I think Maggie will talk a little bit more about that later. There's two supporting worksheets that go with this Schedule A. I'm just going to point out this is details on the cash compensation and on FTEs. A lot of Schedule A is actually driven by the next slide here, which is Schedule A Worksheet. I do want to point out, and this, we saw this earlier too, on an election to use a form, this $100,000 for all pay periods in 2019. So if this is a per pay period test based on 2019. So if in any one pay period last year, an employee was compensated what would annualize to $100,000 or more for a year, they are deemed to be a more than $100,000 employee, not a under $100,000. So for example, you could have somebody at an $80,000 annual salary, but they're entitled to some additional compensation or maybe a bonus. So maybe in one pay period, if they were weekly, they got a $2,500 additional payment in that pay period. That would annualize to over $100,000. And they would drop, you would not list them in Table 1, you would list them in Table 2. So you want to be very careful, and Maggie will show you some of the worksheets that we use to analyze this. Why is it important? Well, you can see that last column is not there, right? The column for salary and wage reduction that's in Table 1 is not in Table 2. That makes those people who annualize at more than $100,000 based on last year exempt from the salary and wage reduction calculation. So I just want to point that out. Be very careful with your data if you're filling out the long form, and I'm going to pass it along to Maggie now.
Thanks, David. And I just want to once again showcase, if this is not your first time on our webinar, our facilitators. So we have these really great tools that we've created internally that basically help calculate and facilitate your loan forgiveness amount. Many clients that we have payroll processing reports that they've pulled for us. And unfortunately, and Janelle can agree that they are not accurate and they are sometimes not correct, if not mostly all not correct, because there are certain specific fact situations that you have to look into for each employee. And unfortunately, the payroll processing reports don't capture those facts and they don't produce the appropriate calculation based on those facts. So when we do get our any payroll processing reports or any payroll information, we do analyze them with a fine-tooth comb through our facilitator to get the correct amount for the loan forgiveness request. So the table of contents, goes through the facilitator. Basically, all that we do in this facilitator is collect the data. So we collect all the raw data that the SBA needs for us to calculate the forgiveness amount. We take 2019 employee wages, so this is for the long form. We take 2019 employee wages because that's our look-back wages. We take Q1 2020 wages. We take our covered period wages. Let me zoom in a little bit. And we also take hours because we calculate FTEs. You cannot just say that a salaried employee counts as one full-time equivalent. You actually need to calculate if they are a full-time equivalent based on how many hours they worked. And that's something that the payroll processing reports don't do very well. And after that, everything self-calculates. We have our 2019 payroll information, as well as the amounts that feed into our Schedule A. So this essentially is the Schedule A worksheet. We calculate our salary and wage reduction. Every single cell in here is hard-coded, and our workforce reduction. And then we have our application along with Schedule A that is available to help you complete your online portal. Like I said, and like we saw, the application is a piece of paper where you have to input every single number. And to do that, you need to do the calculations. And the same with each online portal. You still need to calculate all of these line items. So we have that, and then we also have our easy facilitator, which shows the criteria to file and to use it. You select one of these that apply to you, and it's a far simpler, shorter form of the forgiveness application, and it needs a little bit less input. So we only put in the 2019 maintain information for owners. You could see we did that with Jill and across the way. Far less information to be gathered, hence why it's the shorter form, but the output is the same. And this facilitator serves as documentation. So we highly encourage our clients to really use this facilitator and to help them with the loan application. I think we have a polling question, Sandy.
Yes, we do. Thanks, Maggie and David. The second polling question is it your intention to use the 8-week, 24-week, or something in between 8 and 24 weeks for your covered period? And while we are waiting, we'll get to some questions. Janelle, can we get your thoughts on waiting to apply for forgiveness and choosing the length of your covered period?
Sure, yeah. I think for the most part, the 24-week or the up to 24-week period is probably beneficial. As David said, if you see that you think that there will be a salary or wage reduction, or you're going to have an FTE reduction, just because it does capture all of the information up to the 24-week period, so that you're going to be not only listing the information you have for the PPP funds, which was about 2.5 months of salary. If you have other revenue streams and you're continuing to pay your employees, it captures all cash compensation, not just from the PP funds alone. But again, it's up to the borrower to choose which one they want to use. If they've already spent the 8 weeks and they know that they're going to get their maximum off of that because they didn't have any of these reductions, then the 8-week might be more appropriate.
Okay, so we have 24 weeks is 53%, followed by not decided at 19%, more than 8, less than 24 at 15%, and 13% with the 8 weeks. A couple quick more questions. Is there still a chance there will be an automatic forgiveness for loans under 150,000, do you think?
I wish I had a crystal ball and could say yes. That's completely and totally up to our legislatures as to whether or not they're going to take that up as any of the new legislation they're working on right now. I know it's been bandied about, but I don't know where it's at right now.
Okay, and I think you touched on this, that the whole forgiveness amount can be spent on payroll.
That is correct, yes.
Can I use my payroll provider's report rather than entering each individual on the forgiveness application?
Well, I don't think that there's anything that exempts filling out the form completely. I know I work for the government and we really don't like it when forms come in and they don't look complete. I'd say about the only way you could do that is if your payroll provider's report mirrors those tables on the 4th page of the 3508. Because then it would capture the same exact data in the way that we want to see it. But I also echo what Maggie said, is that you want to be careful about those reports and make sure that they are in fact correct, that they're gathering the right information, because the borrower, the lender is not going to be doing a deep dive on calculations. They're relying on the certification of the borrower. So it's on you to say that, yes, this is the correct information, and you're certifying to that when you sign that forgiveness application. And if there's something wrong with it, the payroll provider is not going to be the one on the hook. It's going to be the borrower.
Okay, thank you. We'll go back to Maggie now.
Thanks, Sandy. Thanks, Janelle. Yeah, I think that is key. I agree that the Schedule A worksheet really needs to be completed when submitted so that you guys can cross-check, so you can't just data dump payroll reports. So that's just something our facilitator incorporates as well. So definitely good to know. So additional recent guidance that came out since our last webinar and over the summer had to deal with compensation to owners. So this is the payroll cost section. So with the new application, we know that compensation to owners is capped at $15,385 for an 8-week covered period and $20,833 for a 24-week covered period. However, there are specific caps determined by the owner type. So what type of owner do we have in the borrower? And the SBA provides guidance on 5 different owner types. I'm going to go through the first 2 and transition off to David E. for the next 3. So the first are C corporation owners of 5% or greater. So if you're a C corporation owner and you own less than 5% of the company, then you don't have a cap. Your cap is the regular cap for an employee, which is the 46,154. So this cap for C corporation owners is 2.5 over 12 of their 2019 employee cash compensation, capped at 2833. So it's limited to 2.5 out of 12 months of the 2019 cash compensation. So there's that. There's the 2833 cap, and add on top of that, we have 3 pluses: plus payment for employer, state, and local taxes, so SUTA, and plus employer contributions for the employee health insurance, plus employer retirement contributions capped at 2.5 months of the 2019 employer retirement contributions. So those are the 3 pluses for C corporation owners that are greater than 5% owners. The other side are S corporation 5% or greater owners. So if you're a less than 5% S corporation owner, your cap is the regular cap for employees, not the 2833. So for your S corporation owners, it's similar to C Corp. You're capped at 2.5 over 12 of the 2019 employee cash compensation, or 2833, plus payments for employer, state, and local taxes, so SUTA, plus employer retirement contributions capped at 2.5 months of the 12 of 2019 employer retirement contributions. What's not included are employer contributions to health insurance, because those are already included in the cash compensation that's capped at 2833. So S corporation owners is a plus plus, and C corporation is plus plus plus. Okay, David E.
Thank you, Maggie. So I'm going to talk about self-employed individuals. So I'm going to leave you with the theme for these next couple slides is the oxymoron simple math. So simple math means 20,833 equals 20,833. So let's talk about what that means. The original PPP language, Maggie had the calculation before, and here it is again, had this 2.5 months. Take your 2019 net profit if you were Schedule C, divide it by 12, multiply it by 2.5 months. That's what you could borrow. That's what you can get forgiven, 20,833, based on a maximum of net income of $100,000. If you had a 2019 Schedule C, you probably submitted the draft maybe back in April. You may have to submit the final one now to substantiate it. If you were a new Schedule C business during this year, you could use your 2020, your estimated 2020 Schedule C. By the time you get to forgiveness, you may be using, depending when you apply, you might actually be using a draft or a final 2020 Schedule C. Just want to point out, same as you saw for the S Corp, the health insurance doesn't count, but also here the retirement and the state and local taxes are not eligible for forgiveness. It's based on the line 34, the final net income from the Schedule C. If you think about it, from that net income is where you pay, as a self-employed person, you pay your health insurance, you pay your retirement, and you pay those other state and local taxes after that number. If you did have employees, of course, you can always put in for the forgiveness for the employees, and if you had other eligible costs. But on the owner, that's the limit. Partners, general partners in a partnership, very similar. Again, it's going to be the 20,833 per partner. The only things I want to point out is that you have to substantiate it, you had to have 2019 net income from self-employment. Basically, that first bullet means the amount that was subjected to self-employment tax on your personal return, the amount that ultimately you paid Social Security and Medicare tax on Form SE with your 1040. So it's going to be the K1 box 14 reduced by other items listed there that reduce your self-employment income, multiplied by this 0.9235, which represents the deduction you get to take for your self-employment tax on your personal return. So the net of all that is what you can use up to the $100,000 per partner, and then limited it to the 20,833. On the second bullet, the magic word there is if the payments to partners are made equals paid, if you want to visualize it paid. And we talked about this in our earlier webinars. the partnership has to make payments, or should make payments to the partners. They should continue to make guaranteed payments, or if they don't use guaranteed payments, make draws against the net income, so that there are payments during the covered period that total $20,833 net for self-employment. So you may actually have to pay out a little bit more than $28.33 to get to the net of $20,833. Again, same as we just saw, health insurance does not count, retirement, state and local taxes. Again, why? The partner at his or her level, they pay those out of their net earnings from self-employment. So you can't use them and add them back to get additional forgiveness. Again, if at the partnership level, because the partnership is the entity that applied or should have applied, they may have employees, they may have other costs. They're going to use all those in their application, but for each individual partner, they're going to be limited to just $20,833. And finally, we want to talk about LLC owners, which are defined separately, but actually relate back to the slides we just looked at. So if you are an LLC owner, you just basically follow how you file for tax purposes. So if you are a single member LLC, a disregarded entity, you're going to probably be filing Form 1040 Schedule C, just like a self-employed person. You're going to use line 34 of that Schedule C and that net income, again, limited to $20,833. If you are a multi-member LLC, the default for tax purposes is a partnership. So you're probably filing a Form 1065 partnership return, and then you're going to default to those partnership rules. So again, looking back to 2019, net self-employment income limited to 100, limiting you to 20,833 during the covered period. The only difference here, if you're a multi-member LLC and you elect to be treated as a corporation for tax purposes, and that's a positive election you have to make, you're probably filing an 1120S as an S corporation, and there you would revert to the S corporation rule. So you might get a little more. You're going to get the 2833. You're not going to get health insurance, but if that entity has a retirement plan and the entity is paying part of the retirement costs for that member, there you may be able to add on some of that retirement costs and the state, if there's any state and local payroll taxes as a corporation, back into the payroll costs for that owner. So that was a quick overview of the other types of structures. And I did want to pose one question to Janelle, because again, this may be one of the areas we're not quite sure yet. What happens if you cut your period short? Maggie talked about this earlier. I don't want to go all the way to 24 weeks, but I want more than 8 weeks. I'm going to cut my period off at 16 weeks. What am I entitled as my owner's cap? Do I have to prorate the 2833 to what 16 out of 24 would be? Because I could have had an 8-week period and used the 20,833. So where am I with a prorated period versus the maximum 20,833 or the 15,185?
Well, that's a great question. I got to tell you, my initial instinct is that there would be a proration, but again, to get the information straight from the horse's mouth, I have sent this question also up to our headquarters level so that I can find out what the actual information is for you, the answer is, and that we can then provide it to the people that are attending this conference.
All right. Well, that's very nice of you. We do appreciate that. So everyone, you see our list is growing, the list of open items and questions. But I'm going to pass it along to David, and he's going to talk about some of the non-payroll costs and some of the new guidance there.
All right. Thank you, David, and thank you, Janelle, and thank you again, everyone, for being here with us. So in the next few slides, we'll cover some of the recent guidance related to non-payroll costs. And one such item is transportation costs, which was really an area of uncertainty previously. And contrary to what many may think, this really has nothing to do with automobile, gasoline, or any sort of those types of related expenses. And what transportation utilities refer to are really just utility fees assessed by state and local governments. And an example that we could find, which also is in the SBA's guidance, is the Oregon Local Street and Transportation Utility Fee. Now, obviously, as you can imagine, this is not likely to be a very common type of utility expense, but we wanted to clarify it nonetheless. So here we'll go through a situation where you may be subleasing a portion of your space to a subtenant, and the recently issued guidance essentially says that you can only claim forgiveness for the net amount of the rent expense. So as the example indicates, if you have a lease where you pay $10,000 a month and you sublease a portion of the space to another tenant for, say, $2,500 a month, you can only claim $7,500 of the net amount of your outflow for forgiveness. So similar to rent, mortgage interest eligible for forgiveness is limited to the percentage of the fair market value of the space that is not leased out to a subtenant, i.e. the space that's occupied by the borrower. So for example, if a borrower has a mortgage on the office building that it operates out of, and it leases out a portion of the space to another tenant, and if the lease space represents 25% of the fair market value of the office building, then the borrower may only claim forgiveness on 75% of the mortgage interest. Now, in practice, I think we can see this posing a possible issue for borrowers in terms of quantifying the fair market value of the space. And I was wondering if, Janelle, perhaps do you have any thoughts as to how to best approach this, or do you really have to do a deep dive into figuring out the fair market value of the space?
Again, that's an area that is still kind of considered a gray area for us. Like I said, I'm happy to send all questions up to our headquarters office just so that we can get further clarification. I think that us doing that actually helps to inform those FAQs that you're talking about, because once they realize that these are actual questions that borrowers have and lenders will have as well, then they're going to put out additional guidance on that.
Okay. Great, thank you. So here we're talking about rent or lease payments to related parties. So for example, if you're renting your office or warehouse space from a related party, there is a limitation as to the amount of rent or lease payments that are eligible for forgiveness. And essentially, the amount of loan forgiveness requested for rent or lease payments to a related party cannot exceed the amount of mortgage interest owed on the property during the covered period that is attributable to the space being rented by the PPP borrower. So for example, if the related party's monthly mortgage interest payment on the property, say $3,000, and your rent payment is $5,000, you cannot, and assuming that you occupy 100% of the space, you can only claim $3,000 for the forgiveness. And on the flip side, if the related party, say, owns the property outright and there is no mortgage on it, you as the borrower won't be able to claim forgiveness for the rent payments because there is no mortgage interest associated with it. And of course, both the lease and the mortgage must have been entered into prior to February 15th, 2020, and the borrower must provide its lender with the mortgage interest documentation to substantiate this payment. And finally, if a PPP borrower has a mortgage payable to a related party, any interest paid on that mortgage is not eligible for forgiveness. And this was another area that was clarified with the recent guidance that was issued by the SBA. I think Maggie, go take over from here.
Thanks, David. So let's go into the FTE reduction exceptions and safe harbor. We get a lot of questions about this. There are FTE reduction exceptions, and then there are FTE reduction safe harbors. So the first you want to look at are the exceptions, and these exceptions, two of these exceptions actually align with the criteria of the Form 3508-EZ. So you really need to first cross-check and make sure you can't use the 3508-EZ based on those criteria that David E. mentioned, and then if you don't satisfy them, go to the FTE reduction exceptions on the long form. So you'll have to use the long form, but you might not have an FTE reduction if you fall under one of these exceptions. And there are technically 6 exceptions that the SBA has provided. The first is that the borrower made a good faith written offer to restore any reduction in hours at the same salary wages, but the employee rejected. It's got to be a written offer. We need that whole documentation substantiation that you have to provide. Make sure that these are written offers and everything is thoroughly documented, because you're going to have to supply this with your loan application per employee, for each employee. The next is the borrower is unable to hire singly qualified employees for unfilled positions on or before December 31st. You also have to document this. And the next is made a good faith written offer to rehire an employee, which was rejected by the employee. For this one, and for the first one, be very careful. If you make a good faith written offer to hire an employee and then they reject it, you are supposed to report that rejection to your state's unemployment office. If you don't do that, we highly recommend that you do not go for one of these exceptions because, number one, that's against the SBA rule. They have specifically said that you must report it to the state unemployment office. And then the other three are employees that were fired for cause, which we're going to ask Janelle about a little bit later, who voluntarily resigned or voluntarily requested and received a reduction of those hours. So if you meet any of these 6 requirements, you will not have a reduction, an FTE reduction related to those specific employees. So technically they will count as a 1 in the FTE calculation. So after you've explored the exceptions, you should go on to the safe harbor. This safe harbor is very broad, and that is that the borrower was unable to operate between February 15th and the end of the covered period at the same level of business activity before February 15th due to compliance with OSHA or the director of the CDC. So social distancing, mask wearing, reduced capacity in the business location. So how do we document this? Because in the application, it just says documentation that the borrower was unable to operate. So we recommend documentation of financial statements. Show that very clear that revenue during the covered period or between these dates significantly declined compared to prior to February 15th. And that's the type of documentation we recommend you show for Safe Harbor 1. And the next is an interesting safe harbor. The only way you can fall into this safe harbor is if you had a reduction in employees between February 15th and April 26, 2020, compared to February 15th, 2020. So if you had a reduction between that time period, February 15th and April 26th, you can claim safe harbor number 2. If not, it doesn't apply to you. So if you can claim the safe harbor, you have no FTE reduction. So that's just the real benefit of these safe harbors. And we recommend that you really look into the application of these and have the documentation available to support them. I'm going to hand it off to David E., the other David, for the non-for-profits.
Thank you, Maggie. So I just have 1 or 2 comments on not-for-profits and the PPP loan process. So it was a little gray up front. There was a lot of information that didn't come out till later. So one of the things that did come out later is the concept of no double dipping. So you see here in mid-June, the OMB, Office of Management Budget, issued a memo that prohibited PPP recipients from being reimbursed twice for the same expenses. So basically that, coupled with some additional SBA guidance, sort of meant that when you applied, you shouldn't have used as expenses from 2019, from your 2019 financial statements. You should not have used expenses that were funded by grants or other reimbursement programs. You should have only used things that were not reimbursed. So rolling this forward to your application for forgiveness, you most certainly should not include any 2020 expenditures during your covered period that were also covered by a grant or other reimbursement sources in your forgiveness calculations and amounts. One thing I want to point out, and this actually is not just for nonprofits, again, the guidance kept coming out and kept building upon itself. So if you were an early applicant, and this goes to other for-profit borrowers, especially like S corporations, if you applied really, really early and you applied under the then current guidance, and you actually over-applied, and in essence, you wouldn't have gotten as much in proceeds had you applied later and followed the guidance as was in effect. You still can keep that money as long as there's a safe harbor out there that protects you to keep that money. But if you applied later after the rules were clarified, especially for like a nonprofit where you should not have double dipped, you probably should be looking at whether you should have returned that money or should be returning that excess loan proceeds. But if you're one of these early applicants, for instance, an S Corp that also used health insurance because they applied on April 5th or 6th before that was clarified, and they got essentially more money than they would have gotten if they had applied at the end of April, there's no direct lineage, and Janelle and I talked about this the other day, and I'm going to have her confirm it. There's no direct lineage between the costs that were used on the application and the costs you're going to apply for forgiveness, because all those non-payroll costs weren't there when you apply. They've been added. So essentially, you can use the non-payroll costs or the additional 24 weeks of payroll costs to fill that gap from what you borrowed to what you apply for forgiveness. And Janelle, correct, they're not going to go back to the application and make a dollar-to-dollar linkage between what you applied for and what you apply for forgiveness, correct?
That is correct. Yes, you're right.
Right. So again, if you're a nonprofit, though, you may want to go back and look at when you applied, look at what the rules were to see whether you over-applied inadvertently, and that may have to be dealt with before you apply for forgiveness. But certainly, you should not be using things that are reimbursed by grants. And if you look in the next slide, you'll actually see the quote that OMB used in their memo. In the third line, it says if you actually used the PPP loans and you got the grants, that it would result in using federal government money for the same expenditures twice. One thing that may help some of the nonprofits who are listening, we have an affiliated entity, FMA. If you go to our website, you can see the link and be linked to FMA. FMA has a toolbox specifically for not-for-profit entities, and in there they actually have a 6-page memo covering this entire concept about not using the cost twice. So with that, I'm going to pass the presentation back to David, who's going to bring us home to the end.
All right, thank you, David. And so I'm going to continue with the next topic here, and that is how to account for PPP loans. So obviously, with calendar year ends quickly approaching, and we think that a significant number of PPP loans still expected to be outstanding, this topic is becoming more and more relevant. First, I'd like to begin by saying that for PPP borrowers, there are for-profit business entities. There really is no authoritative guidance in U.S. GAAP that specifically covers forgivable government loans or grants. So essentially, you will need to pick one of the available accounting models that best fits your situation. So essentially, there are 3 accounting models available for PPP borrowers to consider. The first accounting model, and perhaps the most intuitive, is the accounting for PPP loans under the guidance of ASC 470, which is the guidance for debt. And essentially, you would record the PPP loan as debt on the balance sheet and accrue the interest associated with it until the loan or a portion of it is forgiven, at which time you would reverse the loan and pick up the gain on forgiveness. The second option, and this is really by analogy because this guidance is part of the international accounting standards, is IAS 20, which does in fact address accounting for government grants. Now, some entities may elect to use this guidance by analogy, especially if they believe that forgiveness is probable and that they will meet the threshold criteria for recognition, which is quite high. But we will go through an example on how to record and journalize the transactions under both ASC 470 and IAS 20 in the subsequent slides. And finally, the third model, which is really geared primarily for nonprofits, is ASC 958, which is the nonprofit guidance. And again, this model would be most applicable if you believe forgiveness is probable and that you will meet the recognition criteria, which is that the conditions that are tied to the grant or the loan are substantially met. Now, some for-profit entities may elect to use ASC 958 by analogy, although it does specifically scope out government grants to business entities. Regardless of which of these 3 models you elect, it is important to evaluate the expected compliance with the program before selecting the treatment. And if there is any doubt as to whether or not you will be eligible for forgiveness, it is best to elect to go with 470, which I think is going to be the most common approach that most of our for-profit clients will adopt. And finally, regardless of the treatment election, if you have financial statements that you issue to lenders or other parties, we encourage you to include robust disclosures in your financial statements related to the terms and conditions surrounding the PPP loans and make them as transparent as possible. Okay, so if you go on to the next slide, this is just a tabular comparison of the 3 different accounting models that I just discussed, which describes the presentation disclosure requirements of each. I do want to point out that under 470, amounts forgiven under the program should be recognized as a gain on loan forgiveness rather than be netted with the related expense as allowed by IAS 20. And if you elect to go with IAS 20, the PPP loan would be presented as a deferred income liability on the balance sheet, and income would be recognized over the period in which the entity recognizes costs that the loan intends to pay for, either as a separate heading or under a general heading in the other income section, also referred to as the gross method. or as a reduction of the related expense, either also referred to as the net method. And under ASC 958, amounts forgiven under the program should be recognized as government grant revenue. And we have seen some nonprofits recognizing a portion of the PPP loan as revenue in different reporting periods, depending on their estimates and where they are in the process. Now, in terms of the statement of cash flows, just one thing to point out here is that under both 470 and IAS 20, you will likely need to show a non-cash financing activity related to the forgiveness once it's granted. Now, as I mentioned earlier, we'll go through a quick example here on the next slide. And essentially, we have a situation where a borrower receives a $500,000 PPP loan. Interest is charged at 1% per annum. The recipient believes it is probable they will meet the loan forgiveness requirements, and the recipient expects to spend the loan proceeds over the 24-week covered period, which is approximately 6 months, on payroll and other eligible expenses. So basically, at the time of receipt, under 470, which is the debt guidance, you would record the cash and the debt. Under IAS 20, you would record cash and deferred income. After month 1, and this is important, which I think some borrowers may not realize, you do have to record interest expense each month for the PPP loan. So that works out in this example to $417 and set up a corresponding liability as a payable. Obviously, there's no interest required under IAS 20 since it's not a loan. In terms of income recognition, at the end of month 1, assuming you are spending the money ratably, you would pick up income under IAS 20 of $83,333, and either pick it up as other income or as a reduction in compensation expense, assuming that all the expenses were used to cover payroll, and there would be no entry for ASC 470. So on the next slide, the borrower then receives approximately 11 months after the loan, or 5 months after the 24-week covered period. The loan recipient is notified that it has been released from the debt. And here again, under IAS 20, you will have already recorded all of the income by then, assuming it's over 6 months. And under 470, you essentially reverse the liability for the debt. You would pick up the gain of $500,000, and you would also reverse any interest that you accrued through the 11 months. So that takes us through the accounting for PPP loans on a high level. Okay, so I'm going to continue with this. So the next area that we have gotten a lot of questions on recently is the interplay between PPP loans in the context of M&A transactions. And luckily, the SBA released a procedural notice that was really geared towards lenders, but it does contain a lot of information that borrowers and others involved should also be aware of. And what the notice does is that it provides a definition of what constitutes a change of ownership, and that is that at least 20% of the common stock or other ownership interest of a PPP borrower is sold or otherwise transferred, whether in one or more transactions, including to an affiliate or an existing owner. Number 2, the PPP borrower sells or otherwise transfers at least 50% of its assets, and this is a key point here, measured at their fair market value, again, whether in one or more transactions, or PPP borrower is merged into another entity. So all 3 of these would meet the definition of a change of control for purposes of PPP. And the key here is that for purposes of determining a change of ownership and whether or not the relevant thresholds have been met, is that all of the sales and transfers occurring from the date of the approval of the PPP application must be aggregated. So you have quite a period to look back at. Okay, so if we go to the next slide, if you're contemplating a sale or going through a change of control transaction, what are the requirements? So, as required by the provisions of the SBA 7A program, which the PPP is a part of, from the perspective of the borrower, prior to the closing of a transaction, you must notify your PPP lender in writing of the contemplated transaction and provide copies of the proposed agreements or other documents that would effectuate the transaction and obtain the lender's consent. So this is a key and very important area, is that before you close in a transaction, you must obtain consent. Now, for PPP lenders, and from their standpoint, with a few exceptions that I'll discuss in a minute, the lenders must obtain SBA approval prior to granting that consent to the borrowers in a change of ownership transaction. So now, lender consent is common in most loan documents, and failure to failure by a PPP borrower to obtain such consent could render it in default and required to repay the PPP loan. So that's important to really look at the loan documents. And in an unlikely scenario where a consent is not required based on the loan docs, we would still encourage you to contact your lender nonetheless, and that potentially you consider either applying for the loan forgiveness as soon as possible, or potentially setting up an escrow account equal to the amount of the loan, which is to be released upon the forgiveness being granted. So if we go on to the next slide, so just to clarify, when do you not need to obtain consent from the lender as a borrower? And as you would expect, there are two scenarios under which no consent is required. One is that you have repaid the PPP loan in full, or you have gone through the forgiveness process in full, i.e. you have been notified by the lender that you have been discharged, and what that usually means is that the lender has received reimbursement from the SBA for the loan. And one key point here to note is that, given that at the present time we don't expect a significant number of PPP borrowers to have completed the forgiveness process in full, and barring a delaying, I guess, of the transaction, the only practical alternative to avoid dealing with consents and approvals associated with the change of ownership transaction is to repay the PPP loan in full prior to consummating the transaction. But obviously doing that provides no potential benefit, forgiveness benefit to the borrower. So if we go on to the next slide, as I mentioned earlier, there are some exceptions as to when a lender has to obtain SBA's approval prior to consenting to a change of control transaction. And it's really broken down by whether it's a stock sale or an asset sale, which most M&A transactions fall into. And so with the stock sale, the transaction has to involve either 50% or less of stock of a stock sale, or if it involves more than 50%, the PPP borrower must complete and submit a forgiveness application together with any required documentation to the lender, and it must establish a interest-bearing escrow account controlled by the lender with funds equal to the outstanding balance of the PPP loan to be released upon completion of the process. And similar with asset sales, similar to stock sales, if the asset sales are in excess of 50%, once again, the borrower would have to submit the application and establish the interest-bearing escrow account, which would be controlled by the lender, which to be released upon the completion of the process. So I did want to briefly touch on the next slide on some practical matters that, while most people can infer, it is possible to sort of bypass having to go through the SBA approval from the lender's perspective before granting consent. By submitting the application and by establishing escrow, it's not yet clear whether parties to an M&A transaction will wish to establish an escrow account that is controlled by the lender. So that's something to think about. And there's a couple other things I wanted to point out here from just some practical considerations. The parties that are involving a sale of assets will likely need to consider having the PPP borrower's assets fair valued early in the process, because remember that 50% threshold in the asset sales is based upon the fair market value. Another thing is that if the PPP borrower is still in the forgiveness process, meaning, the forgiveness period, where they're still in the process of spending their PPP funds, it is important that they should ensure that the PPP borrower remains a separate employer for purposes of PPP in order to benefit from the future forgiveness. And finally, transactions involving the sale of assets where the PPP borrower's employees are transferred to an acquiring entity, parties should ensure that during the forgiveness period, the PPP borrower doesn't lose its FTE count. Otherwise, that could negatively impact its forgiveness. And one alternative to that, as the slide indicates, is that you may consider what's called a transition services agreement, or TSA, where the PPP borrower essentially retains its employees and then leases them out. So I'm going to stop here, and we do have a few more slides in this area, but I'll leave the rest of the slides as a reference and allow time for Q&A. But I would love to hear if Janelle has anything to add to this commentary. And if I was to leave you with one thing to one key takeaway here is that if you are contemplating a transaction, make sure that you review your loan documents and contact your lender prior to closing in order to preserve your good standing of the PPP loan. Janelle, do you have anything to add before we get to the polling question?
I will tell you that we've had several inquiries regarding a change of ownership or where they're selling a business that has a PPP loan. And we've been waiting literally for months for this information to come out. So we were very happy to see it when it came out here in early October. Again, if you can mitigate the fact that it doesn't have to come up to SBA for approval of that particular transaction, that's the best way it can be. But we understand that not everybody can, fund an escrow account that has the full amount of the PPP loan in it. We will work on those. It's not like it's a huge backlog of those types of requests, but it's hard to give you a time frame on how long it would take for the SBA to get back to the lender on that.
Okay, thank you for that. Thank you.
So, David, I happened to notice a question that came in regarding what would happen in the case of the death of a shareholder. I suppose some of these change of ownership rules may potentially apply in that case.
That's a great question. I mean, that's not specifically addressed in the guidance that was issued by the SBA. And, I don't have a better answer than that. Janelle, do you have anything that you could shed light on? But I would expect, I don't know.
No, but that would be an interesting scenario. Normally under our regular 7A program, if there is not some sort of succession plan already in place, the lender and SBA would have required probably key man life insurance. But this particular program did not require that. So it would be interesting because I think you're right, Sandy, that there might be some implications of a change of ownership when it is one of the, especially a majority owner has died. That'd be an interesting question.
I think it has to boil down to where is the ownership being transferred to. If it's staying within sort of the family, perhaps that wouldn't be considered. But if it's going to, an unrelated third party, maybe that would trigger it. That would be my thought.
That's possible. I mean, if they're going to keep the same level of ownerships, if no particular person was going to gain a larger amount of shares in the company or ownership in the company, I think that would probably be okay. But if one were to have what we consider creeping control, meaning that prior to this incident, they had maybe 25%, and after the incident, they get 33%, it might be something that we would want to take a closer look at.
Right. And actually, transfers to an existing owner, that does fall within the realm of change in control. So if you do have somebody, that's an existing owner, assuming a larger stake, there could potentially be, assuming all of the other criteria are met, that would probably, could qualify the change of control transaction.
Okay, thank you. Polling question number 3. Do you need help filling out the forgiveness application? And while Jonelle, I also saw a question coming in regarding eligible costs, which the question is, are you required to spend loan proceeds on eligible costs? And as a follow-up to that, I was just wondering, if you submit your loan forgiveness application, do you anticipate that there will be any follow-up reporting to show how you spent the remaining loan proceeds that weren't forgiven?
For the last part of your question, meaning that if they if they weren't eligible for full forgiveness, there was still a balance remaining, whether or not they still had to provide reporting on how they used the last of that money? Is that what you're saying?
Yes.
I don't believe so, because once they go through the forgiveness process, basically those would already be considered either ineligible costs or it might be the EIDL advance that we had on our EIDL loan, because SBA is going to deduct that amount from the forgiveness and before they submit the funding back to the lender. And the EIDL advance has, a different set of requirements on how you can spend that. But what was the first part of the question?
Are you required to spend loan proceeds on eligible costs?
Well, I hearken back to the application process itself. To get the loan, there were certain certifications that had to be made by the borrower. And one of them was that they were going to use the loan proceeds for just those costs that we deemed eligible. So the payroll and those non-payroll expenses that we just talked about in this presentation. If someone used it other than that, because the guidance wasn't out, I think that they might have, a leeway to say that, where David said they could then, maybe channel some of the other funding into those non-payroll expenses if you wanted to help spend the entire amount of the PPP money. But I mean, I think even the certification for the forgiveness application is that they agree that they spent the money the way it was supposed to be spent.
Okay. Do we have results of the polling questions? Okay, if they come up, I will share them. And in the meantime, we also have miscellaneous nuances and remaining open items that Maggie and David are going to walk through some of these nuances, comment on them, and then we'll pull up some Q&A.
Right.
Thank you,
Thanks,
Sam.
Sandy.
Thank you, Sam.
Oh. Well, I can start with the miscellaneous nuance if you'd
Good.
like.
That'd be fine, Maggie. And
So,
we're hoping that Janelle will chime in here and help us out a bit.
Yeah. So one that we get all the time is a reduction in commissions paid during the covered period. And the question is, there's a reduction in commissions paid. Obviously, you may not be at the same level of business activity and your employees aren't receiving that same commission amount. Does that count as a salary hourly wage reduction? And the answer is no. Right, Janelle?
That is correct. Yeah. One of our FAQs actually specifically addressed that when you looked at the salary and wage reduction, you had to look at what the wages that were being paid by the employer, not necessarily the commission amounts, because those could fluctuate.
And sticking with the nuances, I'll go right to the second nuance, which is if you had payroll costs that were incurred before the covered period and paid during your covered period, and some people did, they had cut back on expenses, managed to get their PPP loan, they did owe some back payroll money, it was paid during their covered period, are those eligible for forgiveness? And the answer there would be yes, as long as they're paid during the covered period. They were incurred and paid during the covered period. But at the end of your covered period, remember, at the end of the covered period, you may have a cutoff depending on when your last payroll was and what the period covered by the payroll was. But certainly, Janelle, the payrolls that were caught up during the covered period are certainly eligible, correct?
Correct. Yeah. The guidance that we have out is that those costs are paid or incurred during the covered period. So there is guidance that allows, and as long as the payroll expenses are paid prior to the very next start of your pay date, or by your very next payday, I should say, after the covered period, those still count and qualify as eligible.
Right. And one could say, the employer paid group health care benefits and retirement contributions, those have to be incurred during the covered period or alternative covered period, even though they can be paid outside, they're eligible for forgiveness. So
Yes, correct.
those that are paid outside yet incurred are eligible. Those incurred outside and paid during are not.
Correct.
And just to remind everyone, those are going to be employer net costs. So don't forget, if you're doing your application and the employees contribute to the health or retirement, you're going to have to net those employee contributions out of there, because that's actually in their gross wages. So once you use the money in their gross wages, if they pay for some of these benefits, you can't use it again in those costs. So I just want to put that reminder out there. The last nuance we have listed here is about non-payroll costs incurred before the covered period and paid during the covered period are eligible for forgiveness. And again, that's correct. If you had unpaid rent or other non-payroll costs that are eligible and you caught up during the covered period using the PPP money, they do count. But again, at the end, if you had rent that you paid on the 1st of the month and your covered period ran out on the 15th, you're going to have to prorate that last rent payment, because only 15 days of that payment are in your covered period at the end. Janelle, did you want to elaborate on that at all?
No, that's correct. Exactly what you said.
Let's look at some open items. I know a big open item that I've run into quite a bit is this January 1st, 2020 to the end of the covered period, no reduction in headcount. But what is the look back? So what are you comparing your January 1st, 2020 to the end of the covered period headcount to?
I don't think that they've given us a reference period for that. I think it's strictly only to that time frame. But I hear what you're saying.
I guess, yeah. So that's just one that we look at quite a bit on determining to use the easy.
The next one on the open items, this came up not too long ago, and I thought this was one of the more interesting questions I had heard along the way. What if a borrower, the entity that borrowed the money, is owned by a trust? Are you subject to the owner-employee payroll limitations? And the issue is the trust is an entity unto itself. Now, there are trustees or a trustee or trustees who run the trust. There are going to be, if it's a corporate entity, there are going to be people who are designated by the trust to be officers. They could be the same individual that's the trustee, or they may be different. They may be beneficiaries of the trust. But there doesn't seem to be any guidance out there talking about this particular type of ownership structure and whether it would apply somehow to the owner-employee limits. And I think this is one of those other areas Janelle offered to look into us for us. I don't know if you have any more insight yet on that, Janelle.
I don't yet. No, I've sent the question forward. I haven't received a response yet, but I agree with you. Our guidance has been limited, and it doesn't necessarily specifically talk about a company that's owned by a trust.
The next one is a shortcoming that I've noticed on the payroll processing reports that we get, and that is that a full-time salaried employee counts as one full-time equivalent, but that's not true. You need to look at them on a 40-hour a week basis. And we actually got one of these questions in our Q&A saying, well, what if a full-time employee works 37 and a half? Yeah, they do not count as a full one. Under the simplified method, they would count as a 0.5, and under the regular method, they would count as a 0.9375. But at the end of the day, it actually really doesn't impact forgiveness because your denominator is calculated the same way. So even though they count as less than one, you're kind of canceling them out because you're comparing apples to apples. So that's where the math is really important here.
Right, and
I guess you just have...
Maggie, just to say that there are two, as you said, there's two different methods that are offered in the instruction pages for these applications. And it doesn't include an option where, like you said, if they're a full-time salaried employee, that they get to count as just one FTE. It is based on the average number of hours that they're working.
And I just want to point out to everyone, Maggie, what you basically said is make sure you're consistent. So when you do put a number, a 1.0 or whatever it's going to be, make sure you're consistent with that employee on the numerator and the denominator, or else then you may throw your calculation off.
Right.
Exactly.
Yeah, and as a side note, I have actually seen some payroll provider reports that are not, when you look at their FTE reports, some of them are making that assumption that Maggie said full-time salaried is one. I've actually seen ones where they don't assign anything to them for FTEs. So they're in there sort of as a zero with a placeholder that you, the employer, the borrower, should fill that out. So be careful if you're downloading those service provider reports. Real quick, the next one on our open items, the FTE reduction, what does fired for cause mean? Obviously, I'm going to punt this to Janelle because I'm assuming that that's going to come after we get the answer as to what a decrease in the same level of business activity is, right? So,
right, exactly.
What is fired for cause, do you think that's going to mean?
Well, here's the issue that I have with that. Some of the states that we have are right to work states, so you don't necessarily have to have a cause to fire people. So I think that's an interesting question. To me, it would seem like you'd have to have a reason to fire them, but I've pushed that one up also to our headquarters office, just waiting for them to give us clarification on it.
Great, that's great, thanks.
And another question is, as a result of a reorganization, we see this quite a bit where some employees are transferred out to a related party, a newly formed entity. Does that impact their FTE? So basically they have to transfer employees out of a company to a different company. They technically didn't get fired. Can that fall under the fired for cause?
I don't think it follows under the fired for cause. But again, I've sent this question forward too, but my initial gut instinct is that it wouldn't have an impact because I would think that you'd be able to transfer some of the salary money that's due to those employees from the company A over to company B's books and then pay their salary out of that. I think you have to have, like I said, a line by line, documentation on how to make sure that you can say that those people were still paid out of the PPP funding, not out of the revenues from the new company.
Right.
If I can just jump in for a second, that's an interesting point, because, I think we actually ran into the situation on a particular case, and the company transferred some of the employees to another entity, and they had already spent all of the PPP money. So essentially, these people were being paid. They were being paid out of the new entity with not using their own funds and not using the PPP funds. And so with the position that I think the borrower took was, I didn't fire anybody. I'm going to pick up the FTE count on the original entity where I had these people employed, and then once they're transferred, I'm not going to penalize myself for that, but I'm also not going to pick up the payroll expenses that these people were now being compensated on at the new entity. Yeah, so essentially, they weren't picking up the payroll, but they were still, picking up the FTE count as if these people were still there.
Got you. Yeah. I don't know, but like I said, as soon as I get some further guidance from our headquarters level, I'll be able to pass that on to you guys. But yeah, it's an interesting question. You guys raise great questions.
I pull up a question from the Q&A, and that is, what if, what documentation? I mean, I know we're going to get more guidance about documentation, but the written offers, what if they don't have a written offer? What kind of documentation can they retroactively do? Maybe at the time they didn't have it, but can they do some sort of retroactive written offers?
I don't see why they couldn't.
Getting signatures?
Yeah, I don't think it would be a problem to get it retroactively if it was done orally at first. But I mean, the problem you run into there is, will the employee actually sign it? So far down the road. Yeah. But if they have text messages or voicemails that maybe they can transcribe where the employee said no, I mean, it's kind of a very broad area. It just says in writing. It doesn't say whose writing it has to be in. So
right.
So with a couple minutes left, Tammy, have you been able to come up with some other questions that we can handle?
There was one asked about the $2 million, and do you, on the audit, whether or not 90 days is the time period of the audit, or is there a statute of limitations with regard to loans in excess of $2 million?
They have the same time frame as every other loan. I would assume that if it's going to be a larger loan, that's what would probably stretch the time frame. I don't know that those that are using the S form, the one that's got the 50,000 or less, those I think would be less complicated forms or applications to review. So I think that 90-day time frame that we gave ourselves as an agency is probably for those longer loans. I don't think it will stretch past that.
And thank you. And another one we have is, what box do I check on the 3508 if I have both semi-monthly and biweekly payrolls? Do I check other and explain, or do I check both?
I would check both and explain. I mean, there's nothing saying that you
can't
have additional narratives. So,
right, but if they do that, they aren't able to use the alternative covered period, correct?
Correct.
Here.
Another question is, if we ended up with more substantial FTE reductions post initial 6-week period, so it seems if we extend, we would lose forgiveness on the payroll portion to 75%. Is that correct?
I'm not understanding that question.
Neither did I. That's why I was asking you to see if I misread it.
Well, I think with that is that, to cut off the time, to cut off the FTE reductions, you just need to submit your application as soon as possible. And I just want to reiterate this, that it's 8 or 20. You can't just say, I want 16 weeks and then say submit it at the end of 24 weeks saying you want to submit. You can submit 16 weeks of payroll, but your covered period is still going to be 24 weeks unless you submit it earlier. So
And you have to the end of the year
minimize
as well.
Right, exactly. So, I just want to reiterate that the cutoff is when you submit the application, and that's for the FTE. So you can stop the FTE reduction when you submit the application, not the salary and wage one. And then we have a question about the S form, and that's the entity applying it has less than 50,000, but with its affiliates it has over 50,000. They cannot use the Form 3508S, correct?
It says if you and your affiliates are over 2 million, you can't use the form. I would assume that if they're under that 2 million mark, they would be able to use it. For the one that's 50,000.
Oh, right, under the 2 million.
Yeah.
Correct. So if they're under 2 million with the affiliates, they can use the S. If they're over 2, they can
But
use,
only for the
S.
loans that are 50 or less. So they couldn't submit all of them on the S, right? Yeah.
Exactly.
This is I think we may have covered it, but what is the definition of an affiliate? If you have a partnership with sub-S partners, would the whole group be affiliates?
We have some pretty strict rules on affiliation, and it could be based on common ownership. It could be based on management contracts. So that's something that they would have to discuss with their lender, because the lender is very well versed in what our affiliation rules are.
And one more thing was, the last question I'll ask is, just to be clear, businesses are still waiting for guidance on what is a decrease in business levels. So what other documentation should they be doing? For instance, if they were a movie theater industry and not be able to resume operations?
Yeah, like I said, we don't have a clear definition of what the decrease in business activity level would be. I don't know if it means a decrease in your overall revenues, the decrease in the capacity that you can have in your location. I'm waiting for more clarification on that. Believe me, we have not seen the last of the interim final rules and the FAQs on this program. They are still being rolled out and will continue to be rolled out. So I would just say, continue to monitor either the SBA website or the Treasury website, because both of them have, duplicate platforms for getting this information out to the borrowers, because some of the stuff still needs to be clarified. It just does.
And I have one more, sorry. What if the affiliates are franchises approved by SBA? Are you still required to check the $2 million box?
Oh, that's a very good question. Affiliates meaning that they own several locations under the same franchise.
Correct. I would think, I guess, yes.
Well, Janelle, I think initially weren't franchisees, as long as you had a separate, the franchise code, you were exempt from the affiliation rules initially, when the program was rolled out?
Well, I know that they were exempt from the definition for being small businesses because it went off the size of their locations. And that's how many hotels and restaurants, some of them being franchises, were able to do that. I'd have to get back to you guys on that one to make sure I'm giving you the right information.
Okay. And is there any guidance about asking for less forgiveness than formula forms say that you qualify for? As a church, we are concerned about what's truly needed versus what the rules say we qualify for.
So they want less forgiveness than what our calculations come out as? Is that what they're saying?
That's what they're asking for, yes. Because as a church, they're concerned about what they truly needed versus what the rules, they may qualify for it, but they're worried about what they truly needed versus what is really forgivable, I guess, under this.
Well, the only thing is that, they can submit what they want for forgiveness, although after they do the calculations, it's going to give them what they're qualifying for forgiveness. But if you don't qualify for full forgiveness, the rest of it is indeed carried as a loan, which, that does have to be repaid. So I think everyone, for this program is trying to maximize forgiveness. So that's an interesting question to ask.
Okay, is there any more that stick out at you, Tammy, or?
If rent is paid to, last one, I promise. If rent is paid to a related party and related party mortgages an SBA loan where payments were forgiven for 6 months, are rent payments reduced?
Well, the payments weren't forgiven for 6 months. SBA just paid them for the borrowers for that length of time. So I don't believe that it's considered a forgiveness. Our debt relief program, which is what they're referencing, all of our loans, whether they were 7A, 504, or our micro lenders, they all received 6 months worth of payments from SBA, but it wasn't a forgiveness of payments. We just stepped in and made the payments for them. It wasn't couched as though it was your forgiveness. So I don't believe that.
That seems like that.
In other words, you would still qualify for you would still have to, when you apply for forgiveness as a borrower, you can only use the rent to the extent that it's not rent, right? But to the extent that it's not higher than the mortgage interest.
I think that would fall under that double dipping concept that we covered earlier.
Right.
So thank you again for joining us today. We covered a lot and we hope this has been helpful. Thank you, David, Maggie, and David, and an extra special thank you to Janelle for giving us your time, sharing your knowledge, and for your offer to follow up on those few open questions we had. Be well, everyone.